Hello, this is Pat Walker at MissionWinners.com. I'm doing a video for Nash and for everybody else. And Nash has a good question here. He said that, I've seen stocks that you recommend that you say you want them to gap down, take out the lows of the previous day, and then reverse and go back up. What's the rationale behind it? And I'll share this with you. Is a stock or an ETF has been trending down for a couple of days. It finally has a degree of capitulation, panic selling, and it literally gaps down at the open. And this is a good example right here. Look at QLD right here. It was going down a couple of days. Finally, it has this day where it gaps down versus the previous day's lows, falls, and then reverses back up above the lows of that day. That is a trigger to buy right there. What's the psychology? Again, it's been dropping for a couple of days with the market. Finally, there's capitulation where people panic out of it. It drops a bit more and then it reverses. It gets rid of the last sellers on a move. And what can the stock do the next day? It can follow through and lift. Sometimes it does it with a gap up. Other times it will just do it with a move up. I'll give you an example right here. Been falling a couple of days, chopping around, gaps down from the previous day, falls, reverses, and closes almost up on the day. The next day it follows through. I want to give you another example. I think I can find one for you real quick here. Let's do Netflix. I'm looking here carefully. That's not the best example here. Bear with me. I know I can find more. Hold on. Did Tesla already? Let's see here. QLD back here. Runs up, reverses down, gaps down the next day, falls, closes near its highs of the day, pulls back a little bit the next day, and right there, taking out these highs of this day, that was our entry on QLD. We actually did this, okay? We actually owned it. After a pullback, it takes out the previous day's lows. Now, this is something important. What we want to see is you want to see a gap down. Like, look at where it closed right here. Right there is where QLD closed. Look at where it opened right here. It panics out of it. It's indicative of people panicking out of the stock. Then it drops. And then it reverses and goes back up. That's the kind of selling climax, we'll call it. And I hate to use that word climax because it's not climactic things like this with wide price range bars. But it can be indicative of a change in texture tone of the ETF or stock where the selling is done and then it can reverse and go back. Here's an example. BABA's been falling. Finally, it closes here on this bar. The next day it opens, and then it drops, and then it reverses and closes. Almost closes up on the day versus the open. Almost closes up on the day. But the selling was done. How do I know? It gapped down, it fell, and it closed in the top third of its range. The next day, it gaps up. The sellers are gone. Here we go right here. BABA drops a couple of days. Closes here, the next day opens right there, it gaps down, drops, and reverses up. The selling's gone. Literally, what's happening? The last of the sellers for that short move are washed out and they move on. I hope that helps you, Nash. That's just want to explain that. If you have more questions about it, please ask. That's what I'm looking for. A drop down, take out the previous bar's lows on a gap down, and then reverse and go up. Especially if it's off a moving average like the 8 period or the 20 period. I love those. I love that setup. And that's the psychology behind it. The sellers get worn out, they panic out, it reverses, and it's smooth sailing. And I thank you for asking.